Hi, Joan. So we've had some favorable recent data points, especially regarding the third quarter, but contagion and mobility restrictions are rising all over the world, especially in Europe. What does this tell us about where we're headed?
Thanks for asking that question, Bill. Well, as you know, we huddle regularly with our chief strategist, Van Hesser, who has provided KBRA with a real compass to help us dimension the risks and the broad cross-sector and cross-current credit dynamics associated with the pandemic. We've been writing about the fourth quarter risks for some time and had indeed anticipated a difficult fourth quarter in 2020. Contagion was very likely to reemerge in greater strength as the weather cooled and with it flu season starting, and as people resorted to more indoor activities and as school began. And let's also not forget about the COVID fatigue setting in as a powerful force. So as we know, mobility restrictions have really accelerated in Europe, a region particularly hard hit both in public health and economic terms from the coronavirus pandemic. Those restrictions in Europe are varied. On the one hand of the spectrum, you have Ireland, which has instituted a pretty austere yet practical version of a lockdown. And towards the other end of the spectrum, for example, you have Spain, whereby restrictions have been more attenuated. Like I said, the fourth quarter had always promised to be rocky in our minds, but the strong impact on Europe, which is, after all, the third largest economic bloc in the world, has a global impact. So at the same time, in relative terms, though, we should mention that Asia is doing better and China is chugging along quite well. And the restrictions haven't been meaningfully rolled out just yet in the US, although some critics argue that's coming.
And of course, we now have this groundbreaking Pfizer news with 90% efficacy compared to about 50% for the flu. With very possible positive implications for accelerating herd immunity in countries that receive the vaccine. So how does all this factor into global macro and sovereign risk in your mind? Clearly, the markets are saying it does.
Good question. Do all these fourth quarter dynamics matter all that much if a virus cure is on the way really soon? Well, I'd personally say emphatically not much. We'd all be thrilled to throw away the negativity, throw it out the window, and start planning trips to Hawaii. So there is that scenario, and that's the one we're all very hopeful for. Or there's another scenario whereby the tough fourth quarter digs a ditch even deeper and makes climbing out all the more difficult. Now, consider that rather unfavorable and quite depressing scenario. Oh, sorry about that. That's an audience. I'll re-record this.
Also, can you make sure? I don't know if your headphones are like touching you, because I can hear some shifting. I think that might be it. No, it's fine. I just if you can pull it away from you a little bit, that's okay.
I think the dog barking is actually nice.
Bill, my 88-year-old mom comes to visit on Wednesdays. So is her day. So she times it really well.
Podcast Wednesday.
Yeah, it's better than Unemployment Thursday, I suppose. But
yes.
And she only comes when my son is not home. I don't know why she comes. That's all another topic. Okay. All right. I'm going to re-record this. All right. Good question, Bill. Now, that's a good question. Do these fourth quarter dynamics matter all that much if a virus cure is on the way really soon? Well, I'd say personally, emphatically, not very much. We'd all be thrilled to throw away the negativity, throw it out the window, and start planning trips to Hawaii. So there's that scenario, and that's the one we are clearly all very hopeful for. Or there's another scenario whereby the tough fourth quarter digs a ditch even deeper and makes climbing out all the more difficult. Now, consider that rather unfavorable and quite depressing scenario in the context of the US's economic and financial reality. Manufacturing's up, but services are lagging. Employment creation since the depth of the crisis has been subpar. Balance this against the fact that we're still about 10 million jobs short in the US, and that's quite a steep hill to climb for the world's most important economic engine. In Europe, governments are well on their way towards renewing programs that provide support to businesses, keeping unemployment rates artificially low. Those draft budget plans that were submitted by EU member countries in mid-October might be thrown out the window with Wave 2, and more stimulus could very well be needed rather than the start of fiscal correction. But it's also possible that the groundbreaking news on the virus therapy might alter the course of 2021. We don't have a crystal ball, and we believe that while there are lots of uncertainties, we also think there's promise. And I also would like to talk about the sources of resiliency that might give comfort, even if the pandemic exit isn't immediately around the corner. For Europe, there's additional support coming from the multilateral borrowing under the SURE program, and the Next Generation Recovery Fund financing is on its way. And in the US, and more on this a little bit later, seems we should get another package, at least something, despite the unknowns about the Senate composition. We also have unused firepower, fiscal firepower, under the CARES Act, as the CBO's recent release just showed us. Plus, there's likely more to be coming from central banks, as the Bank of England has demonstrated. The three keys to understanding global dynamics in this crisis environment still rest on three fundamental truisms. The first, virus solution. News from Pfizer is terrific, and we remain hopeful. But we still won't know the take-up by the population if indeed the therapy is rolled out. Nor do we know the short-term, let alone long-term health risks and what could cause a rollout interruption. But we're very hopeful. And second, in the event a cure isn't immediately around the corner, the size of the US package becomes all the more important, as the US is the single most important engine for global growth. In addition, that 10 million of lost jobs, that number really needs to shrink. The long-term impact depends, and this is the third point, on how long the duration of the crisis is and the ability of companies to recover. The long-term impact on employment, given the structural changes that have accelerated, and I just want to say we recently published a piece on that topic at KBRA, as well as the policy decisions executed in the management of the crisis. On another note, at KBRA, we still think we're low for long in terms of Fed rates and rates in the advanced economies. How long is a big question, but it seems pretty firm. While there are certainly risks that accompany that situation of low interest, very low interest rates, the minds that are deciding upon these rates are very cognizant of disruption in the case of a change in policy.
Thanks, Joan. So it seems that we're, like everyone, quite thrilled with the Pfizer news, but at the same time, it seems like you're quite grounded in the short to medium term economic realities. And then, of course, we have the US election to add to the mix. What is your thinking on the impact that the US elections will have on the global dynamics and the impact on recovery, both in the US and around the world?
Well, we know the path forward for Biden presidency is at least partly, very likely largely, contingent on the outcome of the Senate races in Georgia in January and how much the results of that race hamstring policy. However, it is safe to say that a Biden presidency is going to reevaluate the policies of the Trump administration. We don't expect, and we're not sure, we don't expect it will be a large-scale sell-off of previous policies. We recall that was the mindset that colored the behavior of the Trump administration. However, the reliance on executive action is not new. The Obama administration had to do that quite a lot, and the Trump administration too. We share the consensus view here that very likely the theme of the Biden administration will be re-engaging with the world, for example, on climate change, with NATO allies. Whether the tone changes dynamics will depend a lot on the details, but the optics should look less hostile, and that should help reduce volatility at the minimum. And a lot, like outlined before, depends on the trajectory of the virus. If we're not close to a cure, then the Biden administration's priority is going to be the COVID pandemic and healthcare, and that's likely to distract him from global issues and relations. One thing that will be very interesting, and I'm sure we're all watching this closely, is tax changes in the US, not just because of our own pocketbooks, but also because of the powerful effects of that as a policy tool for the global economy. The thinking here is, of course, who's going to pay for COVID? Households, corporates? No one? We're not really sure. We do expect Biden to engage more with the OECD on its tax harmonization and coordination efforts. We also expect the administration will be more creative in its approach to finding taxes to pay for COVID.
We've talked a lot about the US and Europe and other advanced economy dynamics. What about emerging markets? Is there room to manage the second wave in those economies, given the fiscal and monetary space erosion over the past few months? What's your outlook for emerging economies?
I'll give you a short answer to a complicated question, if that's okay. It really depends. Emerging markets are also different, but in KBRA's view, there's a lot more space among higher grade emerging markets. In KBRA's view, there's a lot more space among the higher grade emerging markets. They have not reached the limits of their fiscal or monetary policy capabilities to handle the shock. For the weaker emerging markets, and these all look very different as well, so it's difficult to make sweeping generalizations, the key here will be the availability of financing and more durable debt relief. That's exactly what KBRA is zeroing in on in our evaluation of credit in emerging markets, as well as the scope for these economies to recover. For higher grade emerging market economies, several have positive real interest rates, and this provides scope for rate cuts. The large swath of negative yielding paper in the world, in real and in nominal terms, also creates scope for greater borrowing capacity and further interest rate cuts in emerging markets. I'll take this opportunity just to note that emerging markets in general have been much more resilient than we anticipated to date as a result of the crisis. We have had very few episodes of default precisely linked to the crisis thus far, although absolutely more defaults are likely to come. So much depends upon the development of the crisis and consumer behavior. If tourism, for example, makes a big recovery to pre-COVID levels instantaneously, emerging markets that are especially vulnerable to that will be positioned much more favorably.
Joan, you've always discussed your concerns about China's pre-crisis debt binge and related risk, which, if I remember correctly, you thought were moderated by capital controls. Any update given recent events on that front?
No real update here. China's debt hasn't gone away, and key here is the ability for China to grow without an over-reliance on debt. And much depends upon global recovery, supply chains, China's export sector, as well as productivity gains. But again, not much new to report on this front, at least in our view. However, I do want to emphasize, and I've emphasized this in the past, that China's integration into the global economy does pose risk to emerging markets. We've spoken on earlier occasions, and our audience can find reports and podcasts on this topic on our Sovereign page on the website, or feel free to contact us as well. Weak economies have a heightened exposure to China's debt, and we have to assume that those future debt flows that have been fueling a lot of growth in those economies will be far from copious in the post-COVID world, especially given the disruption and the difficulties in paying back that debt. In addition to the debt sustainability risks that are already evident in many very weak economies, those economies that have been dependent on China financing. Oh, I'm sorry, this is redundant. Let me just cut something out there. Okay, I'm going to do that again. That was redundant. Okay.
How far back are you going? Should you want me to read?
I'll just go from, I do want to emphasize, or should I just record the whole thing over?
I'm just asking, do you want me to prompt you, or are you just going to?
No, it's okay. I'll just record the whole section over. I think that's fine. Well, not much has changed. China's debt hasn't gone away, and the key here is the ability for China to grow without an over-reliance on debt. And much depends on global recovery, supply chains, China's export sector, as well as productivity gains. Again, not much new there to report, at least in our view. However, I do want to emphasize once again that China's integration into the global economy does pose risks to the emerging markets. We've spoken on earlier occasions, and our audience can also find reports and podcasts on our Sovereign page or on the KBRA website, or you can feel free to contact us. In addition to debt sustainability risks that are already evident in many very weak economies that have been heavily dependent on China financing, they'll be confronted with less available capital from China. It remains to be seen if those economies will be able to replicate the growth rates of recent years, although global recovery surely would help. Remember, the pre-COVID period of stability for many emerging markets had a lot to do about debt accumulation. For credit rating agencies, the questions are always, one, can an economy grow without debt? And two, will that debt be used efficiently and produce more dynamic growth?
So with the US presidential election behind us, the next area of excitement is Brexit. What is the Sovereign Group's view on Brexit and let me do this over. Sorry, Lydia. I just wanted to rephrase that a bit and lost it. So with the US presidential election behind us, or it appears to be behind us, Joan, what's the next arena that is of significant global complexity? I imagine Brexit. What is the Sovereign Group's view on Brexit and what's happening next?
I'm not sure if I'd categorize or characterize Brexit as having global significance, but it's certainly very significant in Europe. There's no question on that. The Sovereign Group's view on Brexit is grounded in reality, and that reality is complicated, just like everything else. On the one hand, you have very aggressive policy out of Westminster, and on the other hand, you have a really tough COVID situation in the UK that's far more destructive than 10 Brexits combined. So let's put this all into perspective. But on Brexit and on the negotiations, you do have continued talks, a lot of areas of mutual interest, and it's in all vested parties' interest to make a deal. KBRA is not in the betting business, which is probably good because there have been many, many episodes in this Brexit saga that could have prompted stark changes in our ratings of the UK. But luckily, we are really, really good at zeroing in on credit risk rather than headline risk at KBRA, and that has continued to ground us. Now, we do have the UK's AA+ long-term issuer ratings on watch downgrade, and we will look to decide upon this view at the maximum early in the new year. That position reflects the expectation that we will have enough information to make a rating judgment within the 3-month window within which we like to act on watch status credits. KBRA's credit watch on the UK also reflects the negative trends in terms of the type of relationship the UK is likely to have with the EU. This was signaled by the change in leadership in the UK and the renegotiation of the withdrawal agreement months ago. We are concerned with more than just the risk of an exit from the transition period without a trade agreement.
Sorry, guys. I clicked on, I'm so used to clicking on the Teams icon. I launched Teams. I want to turn it off. So, Joan, anything else in Europe? Can you update us on developments regarding EU integration and the Next Generation Recovery Fund breakthrough that helps socialize and diffuse risks?
Sure. The Next Generation Recovery Fund has, as we know, a loan component in addition to a grant component, and they're about roughly 50-50. Still TBD, but the statement out of capitals in Europe on the utilization of loans has suggested there will be little take-up. Now, in our view, this is a problem because that would mean that the recovery fund has roughly half the firepower of the design originally envisioned and agreed in July 2020. Well, assuming that is correct, that there's not going to be much take up of loans and they're just the European member countries are going to just use grants, and assuming that those countries do indeed need this money, which we have to assume is the case, well, that changes really the outlook for recovery for Europe. So it's something we are watching. I'll note that some of the recent consensus forecasts for Europe indicate not only a deeper contraction in 2020, but a more sluggish recovery. So full mobilization of these funds, which are significant on the European scale, is important. We expect there will be some interesting policy momentum around the Next Generation Recovery Fund in the next few months.
All very interesting, Joan. Thank you. I appreciate all of that analysis, and I'm sure our audience does as well. Good luck.
Thanks, Bill. Thanks, everyone.
All right.
Maybe we don't say good luck at the end. I'm not sure what I was getting at there.
You're going for a good night and good luck vibe. Yeah. Let me stop recording.
That's how I feel after listening to all that. I mean, it was